Adding a teenager to your car insurance policy is one of the most expensive moments of parenthood. The average family sees their premium jump by over $150 a month when they add a 16-year-old driver. That is nearly $2,000 a year. In some states, the increase can be $3,000 or more. You love your kid, but you do not love that bill. And most parents just accept it. They think there is no way around it. They are wrong. You can cut that cost by 60% or more, and you can do it starting tomorrow. By the end of this video, you will know the 6 specific strategies that slash teen driver insurance costs. I will tell you exactly which discounts to ask for, which cars to avoid, and the one legal loophole that can cut your premium in half without changing a single thing about how your teen drives. This is not about teaching your teen to drive better, though that helps. This is about playing the insurance game the right way. Let me save you thousands of dollars, starting with your very next bill. Let me start with the number that should make every parent pay attention. The average annual cost to add a 16-year-old driver to a family policy is just over $2,000. In high-cost states like Florida, Louisiana, and Nevada, it can exceed $3,000. For an 18-year-old male, the increase is even higher because young men are statistically more likely to have accidents. But here is the pattern interrupt that most agents will never tell you. The difference between the most expensive way to insure your teen and the least expensive way can be as much as $3,000 per year. That means one parent might pay $4,000 while another parent with the same teen and same car pays $1,000. The only difference is that the second parent knew the secrets I am about to share, segment 1. The single most effective way to cut costs is to choose the right car for your teen. This is not about buying your kid a beater. It is about understanding how insurers rate vehicles. The cost of insurance for a teen can vary by more than $150 per month, simply based on the car they drive. The worst cars for teen insurance are sports cars, luxury vehicles, and any car with a high horsepower to weight ratio. A Ford Mustang, a Dodge Charger, or a BMW 3 Series will double or triple your premium. The best cars are mid-size sedans, minivans, and older SUVs with excellent safety ratings. According to industry data, the cheapest vehicles to insure for a teen include the Honda CR-V, the Subaru Outback, the Mazda CX-5, the Toyota Camry, and the Honda Odyssey. These cars have high safety scores, low theft rates, and moderate repair costs. If your teen drives a 2015 Honda CR-V instead of a 2015 Ford Mustang, you could save over $1,000 per year. That is real money, but here is the hidden trick that almost no one knows. If you have an older car that is fully paid off, consider dropping collision and comprehensive coverage on that vehicle when your teen starts driving it. Collision and comprehensive cover damage to your own car. If the car is worth less than $5,000, the annual premium for those coverages might be more than the car is worth. One parent in Texas had a 2012 Toyota Corolla worth about $4,000. Adding her teen driver raised her premium from $110 to $270 per month, an increase of $160. She dropped collision and comprehensive on that car, and her premium dropped back to $140 per month. She saved $130 per month, over $1,500 per year, just by removing coverages that would have paid out almost nothing in a total loss. The risk is that if her teen crashes, she pays for repairs or a new car out of pocket. But she decided that risk was worth $1,500 a year. You have to make that same calculation for your family, segment 2. The second most powerful lever is the good student discount. Almost every major insurer offers a discount of 10 to 25% for full-time students who maintain a B average or a 3.0 grade point average. Some insurers also require the student to be in the top 20% of their class. The discount lasts until the student turns 25 or graduates from college. If your teen has a 3.0 GPA, you are leaving money on the table by not claiming this discount. One phone call to your insurer can save you $200 to $500 per year. And if your teen does not have a B average, encourage them to work for it. The financial incentive alone is worth the study time. The third most effective strategy is the driver training discount. Most insurers offer a discount for teens who complete an approved driver education course. The course typically includes classroom instruction and behind-the-wheel training. The discount is usually 5 to 15% and can last for 3 years. In some states, driver education is required for teens under 18 anyway, so you might already qualify, but you have to ask for the discount. Insurers do not apply it automatically. Call your agent and say, "My teen completed an approved driver education course. Do you offer a discount?" If they say yes, send them the certificate. Now here is where it gets interesting. The fourth strategy is something called the distant student discount. If your teen goes to college more than 100 miles away from home and does not take a car to campus, many insurers will reduce their premium significantly. The teen is still on your policy for when they come home on breaks, but because they are not driving regularly, the risk is lower. The discount can be 30 to 50% for that driver. One parent in Illinois had a son at University of Michigan. His premium dropped from $180 per month to $90 per month once he was classified as a distant student. That is $960 per year in savings. You need to provide proof of enrollment and distance, usually a letter from the university or a dorm address. Then ask your insurer for the distant student or student away at school discount, segment 3. The fifth strategy is the one that most parents overlook entirely. Add your teen to your existing policy as a named driver, but do not assign them to a specific car. Some insurers have what is called an occasional driver classification. This is for teens who have access to multiple family cars but do not have a car of their own. The premium for an occasional driver is often 20 to 40% lower than if you assign the teen to a specific vehicle. Why? Because the insurer assumes the teen will drive the family minivan or the older sedan, not the newer, more expensive car. If you assign your teen to your 2023 SUV, your rate goes up more. So do not assign. Just add them as an unnamed occasional driver. Not all insurers offer this distinction, but many do. You have to ask. The sixth strategy is the legal loophole that can cut your premium in half. It is called named driver exclusion. In some states, you can sign a form that explicitly excludes your teen from being covered under your policy. That means if your teen drives any of your cars and causes an accident, your insurance will not pay a penny. You are taking full financial responsibility for your teen's driving. This is a risky move, but it can dramatically lower your premium because the insurer no longer considers your teen a risk. Why would you do this? If your teen has their own car and their own insurance policy, you can exclude them from your policy to lower your own rates. Or if your teen does not drive at all, you can exclude them to avoid paying for coverage they do not need. But here is the catch. If you exclude your teen and they take your car without permission, you are personally liable for any accident. That could be financially devastating. So only use this strategy if you are absolutely certain your teen will never drive your insured vehicles. Some families put a steering wheel lock on their cars or keep the keys in a safe. It is extreme, But for families with high-risk teens or very expensive cars, it can save $2,000 or more per year. Let me give you a real-world example that ties all these strategies together. A family in Ohio had a 16-year-old daughter. Their premium with their current insurer was $420 per month for 2 cars and 2 adults. Adding their daughter would have raised it to $600 per month, an increase of $180. They implemented 5 strategies. First, they bought a used 2016 Honda CR-V specifically for their daughter instead of letting her drive the family's newer SUV. Second, they dropped collision and comprehensive on the CR-V because it was worth only $6,000. Third, they verified her 3.6 GPA and claimed the good student discount. Fourth, she completed a driver education course and they claimed that discount. Fifth, they assigned her as an occasional driver rather than assigning her to a specific vehicle. Their final premium with their daughter added was $380 per month, only $40 more than their original premium without her. Their total increase was $40 instead of $180. They saved $140 per month, over $1,600 per year, just by using these strategies. That is a 60% reduction in the cost of adding a teen driver. Now let me talk about the differences between the US, Canada, and the UK. In the US, the strategies I just outlined work in most states. However, some states like California and Massachusetts restrict the use of credit scores and some discounts, so you may have fewer options. In those states, focus on car choice, driver training, and good student discounts. In Canada, teen driver insurance is similarly expensive, especially in Ontario and British Columbia. The good student discount is available in most provinces. The driver training discount is also widely available. However, the